Welcome to the world of Mark's Money Mind, coming to you from Longmont, Colorado. I'm your host, Mark Troutman. This educational, personal finance show combines money lessons, timely topics, personal stories, and community wisdom to help listeners and viewers master their finances to enjoy a stress-free life of financial freedom. Well, it's been a little while since I have published an episode, and there have been a few things on my mind that I wanted to talk about today. First off, I did just come back recently from a trip to New York City with a group of 5 people. We had a CampFI New York City. We got snowed in. It was quite the adventure and just a wonderful time. And that happened after my last episode. So that's what's been happening since. And I'm kind of back here thinking about things and getting ready for some travels coming up this year. And there were a few things I wanted to talk about. Number one is it's tax return season. Before the CampFI, I had all of my tax information and I said, hey, you know what? I've got all my things here. I should just go ahead and file my taxes. And it was going to be an interesting tax filing season for me because I was going to be using a new form, which I had not used before. And I'll talk a little bit about what that is. So at the end of last year, I did a pretty sizable Roth conversion. And obviously there were taxes due on that. And there are a couple of ways to pay taxes when you have income like that that doesn't have any withholding associated with it like you would with a paycheck. You can make estimated tax payments throughout the year, 4 different payments throughout the year, or you can do withholding from, let's say, the distribution itself, or another option would be maybe if you had a paycheck, you could do some big withholding there or change of withholding. Or you could, in my case, I had an inherited IRA prior to when I was 59 and a half. I could do a distribution and withhold it from there. Or now that I am over 59 and a half, I could do it directly from the conversion distribution itself. One downside of doing that is typically, if you can, it's better to make payments from outside sources than from the distribution itself or the conversion itself, so that more of the money can go into the Roth IRA from the traditional IRA. Now, that complicates things a little bit because the estimated taxes, the way they work is the IRS wants its tax payments evenly paid throughout the year. Now, if you don't know you're going to do a large conversion, let's say, like in my case, at the end of the year, and you didn't make appropriate estimated payments throughout the first 3 quarters of the year, the 4th quarter is due on January 15th. So obviously you could make a estimated payment in the 4th quarter. But the problem is if you don't make those estimated payments evenly throughout the year, you can have a underpayment tax penalty and interest associated with that. So what I wanted to do was avoid that as best I could. And I couldn't do it by reversing time and going back and saying, oh, okay, now that I say I'm doing a large conversion at the end of the year, let me bump up those estimated payments that I could have made earlier in the year. I don't have a time machine. I can't go back in time and make those changes. So another alternative was to just do the withholding from the conversion itself. Being 59 and a half, there wouldn't be a penalty to do that. In previous years, I was able to do it from my inherited IRA, so there was no penalty for making a distribution from an inherited IRA and withholding a majority of that distribution to satisfy the taxes. So this year, I decided to do kind of partially through withholding and partially through a 4th quarter estimated payment. And so I was able to math out how much do I need to have paid in estimated payments in the first 3 quarters of the year. And if I do that through withholding, when you have withholding done, whether it's through your paycheck or through a distribution from an IRA, for example, the IRS views that as if it was paid evenly throughout the year. So that's the benefit of doing withholding. Even if you did it in the last month of the year, the IRS assumes or presumes that it was paid evenly throughout the year. So that's kind of a workaround, but I didn't want to do all of the tax payment through withholding because I wanted more of the money to go into the Roth IRA. So I wanted to pay some of it from outside sources, my savings account, for example. Now, that meant that I would make a large fourth quarter estimated payment, but because it was paid in the fourth quarter, the IRS views that as being late. But there is another way to kind of explain this to the IRS, and that is to file something called Form 2210, and it's specifically Schedule AI on 2210, and that is the Annualized Income Installment Method. Quite a mouthful, but basically what you're doing with this form is saying, hey, my income came in unevenly throughout the year. In my case, I had very little income in the first quarter. I did a very small conversion in the first quarter, but it wasn't significant. And then in the second quarter, there wasn't much income. In the third quarter, there wasn't much income. And in the fourth quarter, there was quite a bit of income, and that was the large Roth IRA conversion. So by filling out this form and explaining, hey, my interest income came in this order throughout the year, my dividend income came in this order throughout the year, and my conversions came in this order throughout the year, you're effectively calculating what your estimated tax payment should be based on that kind of lumpy income. And so this was the first year I did it. It took a little bit of effort, primarily from the standpoint of figuring out my interest payments throughout the year. And it's not an exact calendar quarter, it's a tax quarter. So they're kind of funky in the dates. So you have to get those dates correct and determine what income fell into each one of those tax quarters, and then report that. It wasn't as monumental a task as I expected, so I was pleasantly surprised about that. So if this situation presents itself to you at some point, don't be afraid to use the Annualized Income Installment Method to hopefully reduce or potentially even eliminate any tax penalties and interest as a result of underpaying your estimated taxes throughout the year. So that was the first thing. So that was kind of interesting. And I was kind of excited to do that. And I had all of my other records ready. All of my 1099s were in. And I don't have any W-2s, but any other sources of income, all of the documents were ready. I had everything I needed by the end of January. So I said, okay, early February, before I go to CampFI, let me go ahead and file my taxes. And I did it, including the Form 2210. Tax forms were accepted, no problem, through electronically filing it. I actually got my refund because I did pay a little bit more than I needed to just to make sure I wasn't kind of messing up the calculation. And so I was due a small refund, and it came in I want to say it was like a week. It was super fast. And then while I'm away in New York, through the Postal Service, I get notifications by email on what is coming in the mail. And I see this tax form coming in from Discover, my online savings account. I'm like, what? Why would I already got that? It must be a duplicate. So I get home and I open the mail, and lo and behold, it's a corrected 1099 INT. Apparently, the original 1099 included all of my interest income, and that had trued up, and I saw that it was correct. But what it did not include was there was a point in time in the year, and I think it was at the end of the year, where they sent out an email saying, hey, if you deposit a little extra money, we will give you a bonus for that extra deposit. And that bonus ended up being the figure that was not included on my original 1099. So the corrected 1099 included this dollar figure. I think it was $250 of a bonus, which worked out to about a $60 tax liability on that incremental amount on the 1099. And so therefore I'm sitting there saying, all right, now what do I do? I've got this corrected 1099. I could effectively just ignore it, and the IRS would true it up when they analyze your tax forms that are automatically sent to the IRS, and they would probably send me a bill. Or I could submit an amended 1040, and I decided to do that. So basically what you do is you go back into your tax software and say, okay, I need it to correct this information, and it creates what's called a Form 1040X, which is an amended tax return. And it's basically a cover page to your original tax return that says, this is what was reported on my tax return that you currently have. Here's the difference. And here's, in my case, what I owe, the $60, and it will be deducted from the account that I've stated on, I believe, April 15th when taxes are due. So that's how that will work. So moral of the story is this: I was too anxious, I guess you would say, to file my taxes. So I've heard this before. People say, oh, don't file it until March or even April to make sure you've got all your documents. I've never had a corrected tax document before, especially a 1099 INT. I know sometimes 1099s from brokerage accounts get corrected, but I never really ran into that situation. So I didn't see it as an issue to go ahead and file my taxes. So I've learned my lesson. I've decided going forward, I will not file my taxes until probably sometime around now, the early part of March, to make sure that I've gotten all my tax documents I need, but I keep track of what I should be expecting to receive, and all my checks were there. So I was good there. But again, in case I get a corrected 1099 in the future or some other tax form, I decided might as well just hold off and wait until early March to file my taxes so I don't run into this situation again. So lesson learned. But now that we are in early March, hopefully you're out there filling out your taxes. To me, it's kind of a fun little project. I kind of enjoy doing it. I know that sounds weird, but it's kind of like understanding the rules of the game and applying them appropriately to our tax obligations. So I kind of enjoy doing it, and it's something I like to do myself every year. And I actually also do taxes for some family members too. So that's kind of fun in its own odd way, I guess you would say. So that's the first part of the show. The second thing that has been on my mind is travel. I have a lot of trips planned for 2026, which means a lot of travel reservations to make. And I have found this one app that I've been really enjoying, and it's called TripIt. I don't have any affiliation with it in any way. I actually do subscribe to the pro version, which gives you some extra abilities to load documents or PDFs, for example. So let's say I'm going on a excursion. For example, I'm going to Amsterdam and we are going to see the Anne Frank house. So I'm able to load my ticket into TripIt so I don't have to search through my emails to find the ticket when I'm at the venue to be able to get in. So it's a great way to organize all of your flights, your hotels, in my case, cruises, and even the excursions and all of the ports and things like that. So I've really enjoyed that app, and it's made my life a lot easier. But I do have a lot of trips planned for this year, and I've come across a couple of situations recently, some my own errors, and others that I want to kind of pass along as some maybe words of wisdom or some cautions when making some travel arrangements. So the first one is the letters for the month March and the letters for the month May are very similar, MAR and MAY. And in the rush to make some changes to some itineraries, and I'll explain why I was making those changes in a moment, I made the mistake of changing some flights that were intended for May to March because I was looking at just the three letters and quickly making reservation changes. So the one that kind of tripped me up was we have a cruise with Amberly Grant's FinTalks group to Alaska this year. So that's going to be fun. And it's in May, MAY. One of the things I was thinking about is, so on Royal Caribbean, you get points for every night you stay in a room, and it gives you different status levels. And I also do a lot of cruises on another cruise line called Silversea, which is actually owned by Royal Caribbean. And they have this status match where if you have 30 points on Royal Caribbean, you get what is called VS 100 or Venetian Society 100 on Silversea, as if you had sailed 100 days on Silversea. Now, I've already gotten that status match, but the next status match is if you have 80 points on Royal Caribbean, which is their diamond level, you get VS 250, which is equivalent to 250 days on Silversea. And with VS 100, you get a 5% discount plus free laundry, which has been phenomenal. And one of our slacker friends is actually looking to get that status match on this current Alaska cruise, the FinTalks cruise. So he's looking forward to that. And I already have that, but I was looking at, well, how many points would I be shy to go to the next level, which is VS 250 status match, where I would get 10% off all Silversea cruises. And Silversea cruises can be quite expensive, so an extra 5% could be very significant, especially considering the fact that I already have 2 more cruises on Silversea this year, and it would apply provided that I reach that status prior to me actually going on those cruises, even if I've already paid for them. And I'm also looking at doing a Antarctic cruise at some point, which is quite expensive. So that extra 5% could be super valuable. So I was looking at our itinerary. So we are going to Alaska in May, in and out of Seattle. So I said, I wonder what other cruises are available out of Seattle, either before or after that trip that I could tack on to potentially get the points I need to get this status match. And what's interesting is if you stay in a suite by yourself, you get 3 points per night. So in the FinTalks Alaska cruise, I'm staying in a junior suite, which I actually got a really good price on. So I'm super happy about that. And since I am solo in that room, I will get 3 points. It's a 7-night cruise. So that's 21 points. So that's a pretty good chunk of the points I needed to get to 80. I was already at 49. So that gets me pretty close to 80, but not quite there. So then I was like, well, what else could I do? There was a cruise that was leaving on the same ship, which is effectively the same itinerary. And I was like, I don't know if I want to do that. What else do they have? I didn't see anything that really worked from a price standpoint and a voyage standpoint. And I said, okay, well, Vancouver's not too far away. Maybe I could do something out of Vancouver. And I found another Alaska cruise with a separate itinerary that didn't have any overlap with the one we were already doing out of Seattle, with the exception of one port. So I was like, well, this is great. Maybe I could do that. But I need to get from Seattle to Vancouver, and then that cruise ends in Vancouver. So then I need to get home from Vancouver back to Denver. So how am I going to do this? Because I had already booked my flights, and I had booked them on the Chase travel portal. And normally I don't like to book flights through travel portals because when you make changes, you've got to call them. Or let's say there's a disruption in the flight and you get to the counter and they're like, well, you made this through a travel agent. You need to talk to them. We can't do anything for you. So I really like to book my flights directly with the airlines. And if I'm using points, I can either move the points from, let's say, a Chase, for example, an Amex or a Capital One over to the airline and then book the flight. But in this case, I booked it directly through the Chase travel portal because I had a $500 Southwest credit from that Chase Sapphire Reserve from last year that I wanted to use. So I had to book it through the travel portal. No big deal, but that was the trip I had. I had a flight round trip from Seattle on Southwest. Okay, now I'm going to, instead of fly home from Seattle, I am going to go to Vancouver and then do this extra cruise, get my points, my status match, etc., and then fly home from Vancouver. So as part of all of this math to see whether it makes sense to actually do the second cruise, is the cost of the cruise and the flights and potentially the hotel, because there's a 2-day delay that I have to get a hotel. Does this actually make sense to get the status match? Obviously, the cruise itself will be great, but I did want to make sure that it was making sense that this extra 5% off I would get at Silversea was kind of paying for a good portion of this extra trip, let's say. So I did some research, and here's where the mistake comes in. I'm researching March instead of May. So I'm looking at one of the benefits on the Chase Sapphire Reserve is that if you stay at certain hotels, they give you a $250 credit as long as you're staying 2 nights. That I was. So I was looking at hotels in Vancouver that were in that group of hotels that I would get the $250 credit. And there was one. It was a Holiday Inn Suites, I think it was. And it was $375 for whatever it was, March 14th. And I was like, wow, this is great. $375, and I'm going to get $250 back, and you get a few other benefits like breakfast and things like that. I'm like, this is effectively a free hotel. This is great. And then I was looking at flights, and flights made sense. I'm like, oh, this is going to be a no-brainer. And then the cruise itself was fairly reasonable. So I was like, I'm going to earn this back pretty quickly with the discount I'll get on these future Silversea cruises. So I go ahead and make the booking for the hotel, and then I go into my Chase travel portal, and here I am booking March again, MAR instead of MAY. So I go ahead and I change my flight to March. I get my new hotel in Vancouver for 2 nights in March. I went on a long trip over to Crested Butte, and I get this notification saying, oh, we see your travel's coming up soon. Get ready for your trip. And I'm like, my trip? What trip is this? And it says, you're going to Seattle on March 14th. And I'm like, oh no, I booked the wrong flight. And so then I had to call them and change it. It cost me a little bit of money to make the change. It wasn't a big deal. But again, it was like, I'm dealing with the travel portal representative who was exceptional. But again, it's showing up in my Southwest app, and I can't change it there. I've got to change it over here. And then now I've got to, instead of having a round trip, I want a one-way, and it was just kind of a mess. Anyway, it all worked out. But here's the kind of caveat. I actually booked my trip home from Vancouver correctly. So I did figure out May at that point, I guess, and got the right flight there. And I actually couldn't go on Southwest because Southwest doesn't fly from Vancouver to Denver. So I had to go on United, but no big deal. Then I realized I better check this entire trip, make sure I've done everything correctly. Well, lo and behold, my hotel that I booked in Vancouver was also for March instead of May. So I'm like, okay, well, let me see what it will take to change that. And then I go in and I cancel the one, and I'm looking at hotels, and I'm like, man, these are super expensive for May. What is going on? So I do a quick internet search. Apparently, in May in Vancouver is super popular with cruise season. Makes sense. I'm doing a cruise out of there. And apparently, they are short on hotel rooms for the number of people that typically visit in May, and it's also peak season. And the prices were like $500 a night for most hotels. And I'm like, oh boy, this is going to kind of blow up my whole math here. It's going to be $1,000 for the hotel. I was not expecting that. I was thinking a net 125 between the 375 minus the 250 credit I was going to get. In this case, I still could potentially get the $250 credit, but it's going to be $750 net. And then I look around and I find a Hyatt, and I use Hyatt points a lot and stay at Hyatts frequently. And usually it's, 8,000 points a night or 12,000, sometimes 15,000. But because prices are so high at that time of the year, the Hyatt that I was able to find was 23,000 points per night. So that's 46,000 points. I had the points. I just had to eliminate it out of my mind and just say, hey, you have the points, use it. It's better than paying $1,000. So that's what I ended up doing. So moral of that story is don't rush. Don't confuse March and May. They are 2 different months, and they're about 2 months apart. So be careful there. Lesson learned. Fortunately, I was able to make all the changes I wanted to. Looking forward to that FinTalks cruise. I think we have 60 people on that one. If you're interested in Amberly's trips that she does, go to amberlygrant.com and look at, I think there's a drop-down menu for cruises. And I know she's trying to plan the one for Antarctica in 2028. I believe that's the goal. I'm hoping for Silver Sea. We'll see, but it may not be on Silver Sea. So that should be fun. Anyway, so I am going to do not quite a back-to-back Alaska, but 2 separate Alaska cruises with a stopover in Vancouver. So I'm super looking forward to that. We've also got a trip coming up. This is Kristen Knapp's 5 Friends Travel Group. I think we have 38 people going on this one. It's a river cruise starting and ending in Amsterdam, and it's the Tulip Cruise, and we're doing that coming up real soon, so beginning of April. And there's a whole bunch of us that are going early and staying at a hotel. Actually, I think we've got the whole hotel. It's like a boutique hotel. We're doing some brewery tours and a dinner, and it's just going to be super fun. So it's quite the travel year again, kind of like last year. And I've got a couple more trips that maybe I'll talk about in the future. But so that's kind of my situation with travel. And just, I would say, be really careful about when you make your reservations. The good thing is I've found that it's been fairly easy to make changes. And this happened, I have a trip coming up this summer where I was going to the Baltics, and I switched that to just a trip to Norway. And fortunately, most of those flights were booked with points, and it was pretty easy to change those, actually cancel them, and reroute using new points. Unfortunately, I did get some points stuck at some locations. I prefer to have my points at the credit card companies directly and then ship them out to the different, whether it's a hotel or airlines, when I need to use them. But because I made some changes and had to switch airlines, I've got some points stuck over at different airlines. So hopefully I'll be able to use those in the future. The other thing I've learned is that, and this kind of goes into the next subject here, but because of the war that's going on in Iran and oil price spiking, I'm lucky in that I've made all of my flight reservations, because originally I was thinking, somebody was saying, oh, prices are going to go way up for airlines. And I'm like, really? I thought the airlines actually hedged their fuel costs by buying futures contracts for upcoming fuel. So therefore it matched whatever prices they were showing out there. So they wouldn't necessarily be affected for flights that were already kind of on their books. But apparently that's not the case. Airlines, from what I understand, do not hedge their fuel costs anymore. So airfares have been kind of creeping up here. So if you've made some plans or you have some plans in the future, you may want to lock in those airfares. I've seen some already start to jump for ones that I've already made. And of course, if you go ahead and make those and they come down, you could potentially cancel and rebook and get the money back, or at least a trip credit. So that's something to consider. So be aware of that. When I'm using points, typically I'm trying to book those flights as soon as they come out, because those seats, especially for the premium seats like premium economy, but more so for business class, there tend to only be a few of those points seats available. And typically you can get the seats, but the points prices go up quite a bit. So I'm always looking for them as soon as they come out. So we have a whole bunch of us going to French Polynesia in January and February of next year, and those flights recently opened up. And I know a number of us have been scrambling to get those seats with points. A number of people who are paying cash have noticed that the prices have gone up as a result of the oil prices increasing. So let's talk a little bit about that. We haven't had a market disruption in quite a while now. It's been a while. And normally, I don't know if the word normal is correct, but typically when you have something like a war happen, and hopefully it's brief, but it is a disturbance for sure to the world economy, especially considering the fact that a lot of freight goes through the Strait of Hormuz. and it's being disrupted significantly. And this is an area of the world that is quite volatile. I'm kind of surprised that the market hasn't reacted more negatively than it has. Of course, you may look and say, oh, the market's down a little bit, but it's really not as down as much as I might have expected. And of course, no one can guess where the market's going to go as a result of anything. But typically, when you have disruptions like this, the market is affected. So it made me start thinking about market volatility a little bit and how I am reacting to it, I guess you would say. Market volatility has never really bothered me much in the accumulation years. So in the years where I was just saving and investing for the long-term future, market volatility really didn't bother me. In fact, I almost appreciated it because I was contributing to my 401k or investment accounts through my paycheck. And so when the market went down, I was able to buy more shares with the same dollars. So actually, I viewed market volatility as kind of a good thing in a way in the accumulation years. But now that I'm in the distribution years, I was curious how I might react to market volatility. And I've noticed that I am less comfortable with it if I were very heavily invested in equities and I was relying on those securities to sell to fund my life. So during the distribution period, and I've been in this distribution period for almost a decade now, I've definitely changed my tune as to how I position my assets in order to kind of sleep well at night, I guess you would say. And there's a couple of ways of doing it. I think I've talked about it before on this show and maybe other shows that I've been on about different ways to kind of fund your life when you're in the distribution period. And one of those ways is to, and this is the approach that Jim Solner and Chris Stein use on the Retirement and IRA show, is they like to have secure retirement income cover kind of your, what they call the minimum dignity floor, or let's say Roger Whitney at the Retirement Answer Man would call it your best good life, and have those costs covered without worry, I guess you would say. So the challenge in retirement planning is we don't know how long we're going to live. So therefore, we don't know how long those base costs are going to go for. So how do you match the funding, asset liability matching, I guess you would say? How do you match that funding to something that has an undetermined end date? And one way is to use secure retirement income. Those things would be Social Security, for example, a pension if you have one, or potentially an income annuity if you had one or decided to purchase one. So that's one way to do it. Another way is to fund it purely through asset matching or asset positioning. And the best way to potentially do that without volatility is to have it sitting in cash or short-term treasuries for your near-term spending, maybe fixed income for kind of that intermediate period. And then for the longer term period, you might still have equities for kind of the growth aspect. And I've been doing a lot of kind of soul searching on this, I guess you would say, and trying to understand how am I most comfortable positioning my portfolio so that I can sleep well at night. I've covered my base good life. I've covered my minimum dignity floor. I've also covered my fund spending, because I don't want to be in a situation where I'm potentially already booked on a trip, or I have plans with friends and I say, well, the market's down, so, I can't really do that. I don't want to be in that position. I want to be in a position to say, yes, there's money put aside for that. I'm in, let's do it. So what I've noticed is, instead of looking at my portfolio as this one portfolio that needs to do everything, and it's positioned, whether it's 80-20, 70-30, 60-40, and that means equities versus fixed income / cash, I've backed up a little bit and said, okay, well, what is my expected spending for the next handful of years? And then what do I think it'll be for the handful of years thereafter? And then what is a period of time that I'm willing to say, I don't need that funded today because it could be more of a growth perspective. And in a way, it's kind of like the bucketing strategy, I guess you would say. And Fritz Gilbert over at the Retirement Manifesto released, and I'll try to put it in the show notes, an article about his bucketing approach and how he does it. And it allows him to sleep well at night. And I was like, I guess I'm really kind of doing that in a way. And so the way that I've been doing it is I have a good handle on what my base cost will be. So not necessarily my minimum dignity floor, which is housing, utilities, healthcare, transportation, food, things like that. It's kind of what is my average run rate for my base life, so all of my normal expenses, and then what is the amount of money that I want to kind of have as extra for fun. And so those two figures together come up with an amount per year that I'm pretty confident in, since I've been doing this for 10 years and really over the last 3 to 4 years, including kind of this fund spending, this fund bucket approach that I've talked about before. And so I have a pretty good handle on what that is. And what I've decided to do is be kind of ultra conservative in funding those amounts. And what I do is I actually have approximately 10 years of that funded with cash, short-term treasury ETFs, and some intermediate term treasury ETFs. And that also coincides with 10 years from now, my full Social Security will be turned on at age 70. And I've also put aside an amount of money to purchase potentially, or allow myself to purchase, a single premium immediate annuity, or SPIA, which is effectively a annuity without the bells and whistles. It's a pure income annuity that would coincide with me turning on my Social Security at age 70, which will then cover my base good life, which is a little bit more than minimum dignity floor, but does not include all of the fun expenditures. And so as time progresses, I will keep looking at how many years of kind of reserve do I want to have to cover this base life plus fun. And then down the road, 10 years from now, when the income annuity and the Social Security turn on, at that point, I would really just need to fund my fund number. And we'll see what it is at that point, because that's quite a ways down the road. And then I backed into, well, what does that actually work out to in an asset allocation? And it's somewhere around 70-30, 75-25, somewhere in that neighborhood. So again, I'm still looking at, I wouldn't say it's a bucketing approach, but it's quasi-bucketing, and also understanding that my asset allocation in a broader sense is covering that kind of sleep well at night situation. And I've realized that during this period of time, we really haven't had a lot of market volatility, but I do look at it and say, how would you feel if your equities dropped by 50%? And that has happened in my lifetime a number of times. So I want to understand, what would the portfolio look like if that happened? Well, the 10 years of funding in cash and short-term treasuries and things of that nature really isn't going to be affected. So it's just the kind of 10-year plus portion of the portfolio, which is primarily in equities, that would be affected. And I think I would be okay because of that 10-year buffer, I guess you would say, or bucketing, if you want to use Fritz's vernacular. It's interesting, this period of time we're in, that we haven't had more market volatility. I do kind of like to zoom out and look at the market from a longer term perspective. And when I do that, I notice that the market has been going up for many, many years without much of a decline. So historically, you would think we're kind of due at some point. And so I want to be ready for that. And this is the way that I have geared myself up for that potentiality, I guess you would say, and be prepared for that if it happens. And it doesn't affect my near-term spending or things I want to do with friends and family. And I won't be in a situation where I need to say or feel like I need to say, I need to dial back and take some things off the table because we don't know how long we're going to be here. I don't want to be in a situation where there's regrets that I wasn't able to do stuff because of some outside force of the markets not doing well, for example. So I've really given this a lot of thought, and that's kind of where I am right now. Now, to flip the page a little bit, now I'm putting my daughter's, thinking cap on. And if I am saving for the future, I'm not really worried about this at all because I'm just putting money away. The goals are so far in the future. Market volatility, almost welcome it because that means any future dollars that you're putting in, maybe you get a little better pricing and you would prefer that the market not rocket away as you are saving and investing for the future. You kind of want it to potentially have declines on occasion because as you're dollar cost averaging into the market, as you are when you're saving throughout your lifetime, those volatile periods can actually be beneficial. So for the younger individuals out there in the accumulation phase, if the market has some volatility in the near future, or when it does in the future, which it will at some point, I don't know when, but likely will, as in the past, will likely continue in the future. Don't fear it, embrace it, and look at it as an opportunity for your dollars to go a little further. So that's what's been on my mind recently. I thought this would be kind of just a little episode of a few things I've been thinking about. And until next time, I hope you have a wonderful spring. I know it's warm here in Colorado. We have not really had much snow this year. I'm a little worried about the water situation, but it is kind of nice to have some warm weather. But again, hopefully it doesn't affect us from a water standpoint. And I know it's super windy and cold in the east. Man, it was crazy. That snowstorm we had at CampFI, that was crazy. I know people in the Midwest are having some big storms right now. So I hope everyone is safe and sound, and I will talk to you soon. Thank you for listening to this week's show. Please click follow on your favorite podcast player or subscribe on YouTube to ensure you don't miss any future episodes. Also, please leave a rating and review for the show. This helps improve the ranking and enables other like-minded people find the content in their podcast players. I would also appreciate it if you would recommend this show to friends and family that might benefit from this content. See you next time on the Mark's Money Mind Show. Until then, make some, save and invest, live on the rest. Now, for the all-important disclaimer, this show is for education and entertainment purposes only and should not be considered investment, tax, or legal advice. Please consult the appropriate advisor or advisors before implementing anything you hear on this show or any other show for that matter. While I fully intend for everything on the show to be true and accurate at the time of each recording, occasionally errors may occur. So please do your own due diligence on anything discussed.